Let's talk about covered calls. This is a great income strategy that I like. Some people think it's great, some people think it's not so great, but I think it's a great one to learn as someone who's just dabbling and beginning to dip their toe into paper trading with options. And it involves when you own a stock. So remember, when I own it, I'm long. Excuse me. And then I'm promising to sell that stock at a higher price, and we'll decide what the risk graph looks like. Now, in both examples, we talked about the idea of being naked and being covered. And in selling our put, we're simply promising to buy a stock. And if we can keep that promise, because we have cash to buy it, well, that'd be a cash covered put. We're covered. If we didn't have the cash to buy that, we'd be naked. Well, the same is true here. What we're going to do here is we're going to look to get paid by selling our stock, right? We say, hey, we're going to sell it anyway at a certain price. Well, why not make someone a promise to do it and get paid a little premium on top? So when we say covered call, covered involves that we buy a stock and then we sell a call for income. So if we did not own this stock, we'd be promising to sell a stock that we don't own, and that'd be naked. But since we own it, we have the ability to make that promise. Just always remember, if you're going to get paid by making a promise, first decide whether or not you have the ability to keep that promise. Think of it this way. If you're going to sell insurance and someone had a $50,000 car and you said, look, I'll insure that. Well, you probably should have $50,000 in the bank to insure that car. Otherwise, you'd be making a promise where you're naked. So we like covered in contrast to naked if we want to be conservative. So that's fun stuff. Now, we're going to do these out of the money. You can do them in the money and at the money. That's going to be for the advanced options class, ultimate options. We're going to do this a little more conservatively. There's going to be less income doing it this way, but it's going to allow for a little bit more upside in our stock. So these are going to be out of the money calls we sell. And our objective is to get income from our previous stock purchase. We like dividends. We like getting cash flow from dividends, but we can also get income from the stock. So let's draw a financial statement here just for fun. And let's say we own a stock now, right? Maybe we own 100 shares of stock. Well, we could certainly get the dividend every quarter, right? They divide those profits up. Dividend, like that. But we could also promise to sell our stock at a higher price. We're out of the money. So promise to sell. Now, why might a person do this? Well, let's say here's the stock, and I don't know, maybe it's trading at $30, and it's been doing this. It's been doing this, and this is about what it's been doing. And up here, we see that it's maybe $35 over a month. And so we say, you know what, $40. We see that, it's probably not going to get there, and if it does, it's probably not going to go much more than that. So if we said, you know what, I'd be happy to sell it here. I could always buy back in. But if I can get paid some extra cash for promising to sell, let's say at 40, when I don't think it'll probably get there, it's certainly not trending steep enough to get there. And if it did, well, my gosh, I'm buying at 30 and selling at 40, I get $10, and it's probably not going to go much further than that. So I'm taking a bird in the hand instead of two in the bush. And so that creates another additional income from a previous stock purchase. Not only can I get the dividend, but I could get paid promising to sell it. Now, what's cool about that is if this were to fall down, I still get the dividend and I still keep that premium. So it reduces my risk as it falls because I'm getting this. Selling them way up here out of the money gives me a little more upside, where I can buy at 30 and sell. If I did it at 37, that's less upside. And then it does cap the potential at the price I sell it, though. So we'll look at a risk graph, and it becomes more and more clear. Not very often I call this a conservative trade. Very few are on my green aggressive meter. I tend not to do that because if I say something's conservative, all of a sudden people think that means safe. No, it doesn't. It just means there's less risk, perhaps with this than a naked one or some of the other things we do. So our biggest risk here is losing out on a big upside. That's the risk you have. You don't have any more risk here than buying stock. In fact, you have less because you're getting a premium. And this can be done in IRAs and easy stuff. So we were using Kraft Heinz as an example. I'm going to show you some naked stuff first. So the first trade we made, to review this example of just this one stock, and you can practice with others, is we're going to have KHC here, and we're going to promise to buy it at $32.50, and we brought in $1.22, right? Well, one of the things I did that you will not do as a beginner, at least as one of my students, you probably wouldn't do it, is we also sold a naked call here for 88 cents. And so we brought in 122, promising to buy it at this level. And even though we didn't own the stock, we said we'd promise to sell it at this level. Now, notice this was much higher, that we'd have to make another move, and we just didn't feel it would go much beyond this resistance point. And you have to have some risk management to figure this out. Had it exploded up here, we'd have been in trouble. We'd have had to buy it at the high price and sell it down here at 35. So there's an unlimited amount of risk when you sell these naked. I mentioned earlier that I'd talk a little bit about naked calls so you know what they are. It's kind of like saying this is a rattlesnake. Once you know what it looks like. Now, why am I doing this? Well, I'm comfortable with these because I know how to manage the risk, and I have my ultimate options class. So this one would be naked. But you'll notice how it's reducing our cost basis lower and lower and lower. I'm going to assume that in this example that it went down and got put to us. It didn't. It stayed above the line, but let's just pretend that we picked it up at 31.28. In this example, we went through and we sold another naked call here and another put here and another naked call here because we didn't own the stock. But you'll notice as we brought in all of these premiums how low our cost basis was getting. And it got down there pretty far. We eventually were able to buy this at a low price. And that way when it bumps up, you get a nice gain here. So far this one has worked out very, very well for us. And we'll see how it goes in the future. But we've got I'm very happy with my cost basis in the 20s. We're going to use one a little higher than my cost basis because you wouldn't have gotten those premiums from selling naked calls as a beginner. So we're going to go and we're going to say, let's say that you would have received this stock. Maybe you didn't get as good a cost basis as I did, but let's just go with that 31.28. So you're the buyer, which means you buy the stock, and let's just call it 31.28 like you promised. And over here, this person sold it to you, sold the stock. So that's what that transaction looks like. And, you gave him $31.28, and he gave you shares of stock. We'll just say 100 shares. And so he sold the stock at 31.28 to you. That's pretty easy to understand. So now that you've bought the stock, you have this financial statement that says I have 100 shares of this. We'll call it KHC just for fun. You have 100 shares of this and you paid $31.28. That's your cost basis. Now, this might have gone up, might have gone down, but let's just put it in there as if it was the day you bought it. And you might turn around and say, if that thing was able to get to $33, you could say, look, I promise, watch this, to sell my 100 shares of KHC, Kraft Heinz Corporation, at $33. Now, why might you do that? Well, this thing hasn't moved much, right? You can go a month with this not moving more than, $1 or so. And maybe, if you could buy it at $31.28 and sell it at $33, you make yourself a nice little profit. And maybe as you look at your graph here of the stock, you see it at 31.28 here where you bought it, and you say, you know what, I just don't think it's going to get to 33. And if it does, I don't think it'd go much beyond 33. And so you say, yeah, I'd let it go for 33. And, if I still like it, I can buy back in. Certainly not going to lose money, but I just would lose my upside potential past 33. Well, this guy's a gambler. And he said, I'd like the choice to sell, to buy this stock. So he's going to be the owner of the call. You're the seller. He's the buyer. I'd like the choice to buy it, 100 shares of KHC at $33. Now, why would he do this? Well, he doesn't want to pay this $31 to find out. He'd rather pay you. You're going to give him your promise, right? That's what you're going to send him, this promise you make, right? And he's going to send you some type of premium. So the question is how much is this guy willing to give us to make this promise? And we'll see if it's worth it or not. So let's get out of theater mode and pull this aside. And let's bring up our option chain first and our stock. And we say that, my gosh, since we got this down here, it's climbed way up. It's 32 something now, and we say, looks like we've got some resistance here around 33. Maybe we predict that, it struggled to get above 33 and it dropped down. It struggled to get above 33 and now it's struggling again to get above 33. Maybe we think it's going to drop down. So we say, look, if we can unload this and get paid around this 33 area right here, which would be right about here, right, 33, we say we'll go ahead and get rid of this at this resistance point. We're happy with that. And if it goes up without us, well, gosh darn it, we'll have to buy back in, and maybe we sell a put to buy back in on a dip. So we say, yeah, we'll do this. So the question is, how much money would we get? And since we're going to go, one strike out of the money, we're not going to get as much, but let's go out about a month or so. I said 6 weeks was about as far as I'd go, and that's about 6 weeks from now. So we're happy with that. And we say, you know what? We'd sell it at 33. Well, here we have 55 and 65. We said we could split that spread, so that's going to be 60 cents. If we offer 60 cents, they're asking 65. They're offering 55. I'll bet if we said we're willing to make that promise if you pay us 60, they're probably going to take it. Again, we like the idea of looking at the mark and saying, hey, what's the mark? And you see here it's 60. It's between these two. So we like giving the mark and splitting the bid-ask spread, and that's great stuff. So that's fantastic. So let's do this. Let's say that we've purchased it at let's see. Let's just buy it here, and we bought it at 30. Our cost basis was 31. What did you say it was? We'll pretend it was 31.28. Good enough. So that's our cost basis. And if we look at our risk profile, that's what it would be. So, we bought it here at 31.28, and now it's up here at 32.85, and say, hey, that's great. And we'd be willing to sell it here out of the money, close to at the money at 33, maybe 34. So let's go 33. That's right at resistance. And we say to ourselves, man, if this thing's going to drop back down, the candles seem to look like it might. It's got a doji right here. I don't know if it will or not, but boy, if we can sell this thing at 33 and get paid extra for it, that'd be pretty cool. Well, looks like here they'll give us 60 cents extra for it, right? 60 whole cents extra to buy that just a little bit higher than it is right now. So that's pretty cool. That means we're buying at 31.28, we're selling at 33, plus we've probably collected a dividend along the way. Let's see if there's a dividend in there. There might be. Do I have those showing? Probably not. We could do that. We should probably find where the dividends are at here. Let's just say show the corporate actions. Maybe that does it. There we go. So we got a dividend of 40 cents here, maybe on the dip when we bought it at 31, 70, whatever it was. And so we got a nice dividend here. Looks like we'll have another one here if it goes back down. Plus we can get 60 cents. That's a pretty good deal. I like that plan. Let's try that. So let's take that. Let's say, Yeah, we'll sell this for 60. So we're going to jack this up to 60. And we're going to sell one of these. And bam, there's our risk graph of the covered call. And you'll notice right here that, if it goes up, we're really limited in our upside. Why would we do that? Well, technical analysis, right? Looks like it jumped up, kind of hit its head on this resistance right here. We'll say, you know what, if it blows through, great. But if it comes back down, we'll still get our dividend of 40 cents. We're going to get our 60 cents here, which is going to give us our cost basis was what? 31.20. So that's going to drop us clear down here. Our cost basis is going to be awesome now because we have so much money we've made from this. It's going to have to go really far down before we'd really have a loss. So this is really cool, which you could have if you bought the stock anyway. You could have a loss. So this is just ways to squeeze more money out of things and have some fun. So I like that trade. Okay, so let's see if we can figure out how that risk graph would work and see if it makes sense to us now where we can draw on ourselves. So we know that we're doing 100 shares here. One contract is 100 shares, and we know we have 100 shares at 31.28. So at 31.28, well, shouldn't that be our break-even point? Shouldn't we go here at 31.28 and say that's our break-even point? Oh, nope, because why? We've got another 60 cents we brought in that way. Well, 60 times 100 is, sure enough, it's about $60, isn't it? It's about $60. So pretty cool stuff, right? If we get it right about here, that's about $60. So awesome. Here's 50, here's 60. So very, very cool. Our break-even point now is clear down here at about 30 and change, maybe $30.60 some odd cents. So we're reducing our cost basis from 31.28, minus 60 cents, whatever that is. Should we do the math on it and do it right? We know that we are going to pay, we paid $31.28 for this stock. And now we get to take this down by another 60 cents because we made it. So sure enough, we're at 30.68 now in terms of our cost basis. And check this out. If we get another 40 cents, right? If we get another 40 cents for the dividend, now our cost basis will be down to 30.28, which is clear down here. So the more we do this, the further this has to drop for us to begin losing money overall in the overall trade. It's one of the advantages I think people can consider in doing this. Now, are we limiting our upside? We certainly are. And I probably wouldn't do it this close to the money if I didn't have technical analysis that said, hey, got some pretty serious resistance here. If I'm wrong and it blows through, guess what? We still get to keep our 60 cents. That was the deal, and we'll let the stock go at 33. We'll have bought it at 31.28, sold it at 33. So there's a couple bucks. I make the 60 cents. I'll miss out on that dividend, but guess what? Maybe I'll sell a put right back at 33, and I'll get right back in where I left off and keep on rolling, right? The ability to get back in by getting paid to buy, getting paid to sell. I've had people say, well, that sounds like the Wheel of Fortune. Well, not always, but that's the idea. Yeah, I would not do this if it wasn't at resistance. Probably wouldn't do it. And you know what? Maybe I don't want to be that greedy. Maybe I say to myself, you know what? I'll just take this one. I'll go to 33.50, or maybe I'll go to 34. I mean, look at this. $34 would give me, what's the mark between that? Up here, it's going to be 27 cents, right? 27 cents. Well, watch this. If my cost basis, if I get 27 cents, and my cost basis divided by is pretty low. And you got to remember, if I bring up my PowerPoint again, we've been doing this for a long time. And if you remember, we got our cost basis down to about $24.89, right? So assuming I get a cost basis of that's pretty good. But let's just divide it by our 31.28. just to see. It's going to be under 1%. So yeah, 0.008, just under 1%. But watch this, times that by 12. That gives me another 10% on this stock if I do it every month. And I got to tell you, that's pretty good, getting an extra 10% for promising to sell at 34. Now think about that. You bought clear down here at 31.28. You're promising to sell at 34. That's what, $4 almost, $3.70 some odd cents you'd make on that 100 shares. And we also have to think to ourselves, is it really going to get here? It'd have to break through and really have a run to get above there. So you could even do that and say, you know what? I'm not going to be greedy. I'll take 27 cents, right? I'll take 27 cents, or maybe I try to hold out for 30 and see what that does to my risk graph, right? So now, now I've got some more upside in this. Now it's really got to run a little bit. And if I do, like I said, I'm going to make like $300 on this baby. So that's kind of fun stuff, really fun stuff. Very conservative, and you can see how my cost basis goes down. And if I get to keep that stock, I get to add another 40 cents on the dividend. I might be inclined to do this one. I'm a pretty conservative guy, and people are going to say, really, Andy, 27 cents, 30 cents, 25 cents, that's not that much. And what I'd say to them is, well, yeah, but if I'm collecting that over time, month after month after month, that's like getting another 10% on this trade above the dividend. And you'll remember, our dividend on this was looking pretty sweet. Let's go back and look at that dividend again right here. If you remember, our dividend, we were already at 6% on our dividend. If we get that cost basis, you add another percent to that, or another 10% of that, that's 16% on the stock, where it's not really moving that much, right? We're using the time decay and also the quarterly dividend. 16%, that's pretty good, combined with a low cost basis, a great dividend, and this. So this is very conservative stuff. And I was a little frustrated because when I learned this, the instructors were trying to make it exciting. So instead of finding these little 1% premiums out of the money, they were finding like 5% or 10% on these pharmaceuticals. And, those are pretty risky. Those are pretty volatile. I would submit to you that most people that have traded would say this is a pretty conservative thing. And sometimes you're going to get called out. They're going to take your stock from it. Well, great. Write a cash covered put and get paid to buy it back on a dip, or just go in where you left off. Maybe you're paying a little bit more for it, but I just feel that if you can get a bird in the hand, it's a choice that you'd want to know about. It's a choice that you could do. So that's out of the money covered calls. The risk graph is these will get easier and easier to understand as you get to play with them. Of course, in the Ultimate Options course, we do these every week. For almost 50 weeks in a row, we're doing a couple of these, 5 or 6 every week. You get really good at it when you do that many, and it's really fun. So that's the covered call. That's the risk graph of a covered call. You'll notice that we're capping our gain, but watch it jump. See how much more money we make. So we're capping our gain if it goes up here, but we look at this, we say, God, is it really going to run crazy? It's had one good bump, maybe a little run here, but we're feeling like we're acquiring a company that'll probably be around. It's got some debt in its fundamentals. We're getting a really nice range of where it likes to be technically right now, it seems. And we'll see if long-term this trickles up. And that's really what we like to see, is a nice little realistic, upward trend to this. And if it goes down, well, we certainly had that risk of owning stock anyway, but we get the dividend and we get the premium. So as I said when we talked about premium, the love of money is the root of all evil, so the good book says. But it doesn't say that we can't love our premium just a little bit. So that's your covered call right there. That's the covered call.